p.m. Top Tips Wednesday continues with Your Money, Your Call.
The energy index flew ahead today by over 5% to drag the Australian market upwards by 0.5%. It was back to 2010 with resources and energy strong and industrials flat. The All Ords has now recovered 5.5% from the bottom of 4958 this time last week. Much of this recovery has come from the resource and energy sectors, although the industrials have also played their part as well. Hello and welcome to Your Money, Your Call. I'm Ken Bloomfield from Financial Clarity. If you have a question about shares, our phone lines are open on 1300 30 34 35, or if you prefer, you can email us at yourmoney@skynews.com.au. Now, joining me on the panel tonight is an old veteran. Can we call you that, Ben?
Sure.
Is that all right? Okay.
Yep.
Old vet Ben Clark from TMS Capital, and Carl, who's been on the show for quite a long time now, Carl Capolingua from Investor Systems. Welcome to the program, gentlemen.
Ken, thanks.
Been a pretty volatile time since I've been on the show. I've had a little month off, so I haven't been on the show for a month, and it's all been happening, Ben.
It sure has. It's a good time to take a month off.
Yeah, well, I haven't had a month out of the market, off the show, but it's been extremely volatile.
Yep. And
now the market's recovered pretty strongly in the last week, and it's sort of in that band now, it seems, between about 5 and 5.5.
Yep.
So, you know, we're at 5222, I think, 5228, I think, today, so sort of halfway in that band. Where do you think we go from here, Ben? And
I reckon the volatility is going to continue to sort of die down, and I think the markets will continue their recovery. Not in a straight line higher, of course. You know, there might be another retest at that 5,000 sort of point, but seemed to be where some very strong buying support kicked in. But I think the big news, Ken, is the US interest rate rise now appears to be pushed out to next year, and we're getting that risk-on trade flowing through again. Commodities higher, Aussie dollar higher. You know, emerging market.
Your bad news is good news again.
Right. Yep.
Right,
and the China sort of bad news seems to have just been dying down somewhat in recent times, and I think as the volatility calms down, yields are looking very attractive again, I think, versus the cash rate.
Yep.
You'll start to see money push back into the market.
Yeah. Okay. And Carl, what's your feeling at the moment in the market?
Look, pretty similar. I think we dodged a really big bullet actually over the last few weeks, because we flirted with that 5,000 level so many times, and such a key, both technical and psychological level. And I think it's been said, because we held it so many times, I think the market's got a little bit of confidence there. And putting aside whether you're a longer term or shorter term investor, I think either way you've got a nice little stop loss for your trades. If you are going to put some money on the table here, you know where that stop's going to go. It's below 5,000, and I think the market will treat 5,000 in that way. So if we get below there, watch out, because it could precipitate some of that money that's coming in, our speculative money, washing back out, and a few longer term holders giving up. I think we are, I was going to say, out of the woods. Let me not say that. I'm going to say I think we've got a bit of breathing space to potentially put in a bottom here, but it's far too early for me as a technical analyst, using the trend following indicators I do, to call that, because it always looks darkest before the dawn as a trend follower, and always looks most brilliant before the turn from the top. So I think more of a sideways, maybe a gentle upwards movement. If you look at the last few times moves like this has happened, I'm talking, 1,000-point move. We went 6 to 5. Back in 2011, we did 5 to 4. And made a base at 4, and took us a good 6 months before we started to really put in an upward move. And I wouldn't be surprised if we saw something like that. So I think it's a bit of a spec buy at this point in time, but anything outside of a few months down the track is impossible to call. So
it certainly seemed like a pretty major turning point with the jobs numbers on Friday coming out of US being so weak. With that, as you were saying, Ben, with the idea that the Fed's going to put, back their interest rate rise, everything changed. The dollar started rallying as well, which was a really, strong sign that that was the thing that was really driving the markets. Where do we actually go with commodities from here, though? Because commodities really, if you want to look at this downturn, it's been about China and it's been about commodities in the last 6 or 7 weeks. Commodities really got smashed. And today we had, the energy index up 5 or 6%. Do you feel that this is anywhere near a commodity bottom at this point in time, or do you feel there's still a lot further to go through the cycle? I
don't think we're at the bottom. In industrial metals, so iron ore, copper, etc., I still think there's worse to come. I think China is transitioning from an investment-led economy to a consumer-led economy, and I think the leadership in China seem reluctant to support the area of the economy as they make that transition. And I think those who are sort of calling for stimulus in that area are missing what's going on. I think if there is stimulus, if the Chinese authority sees the economy sort of push lower faster than they'd like, the injection will be on the consumer side to try and stimulate spending, as opposed to going and building another 14 airports, which is what happened over the last 10 years. I'd be more optimistic on oil. I think some supply is going to be taken out of the market. Oil's a global sort of story, and to me, oil at $40, $45 look cheap, but the volatility will continue. But I think it will trend higher over the medium term, and I think you get pretty interested in oil at these levels. But I still think the main commodity area of our market's got worse news to come. Yeah, okay, interesting. And what do you think, Carl? With iron ore in particular, it's been really interesting to see Fortescue, for example, rally back over $2. It's not a stock that I'd be going anywhere near at this price, but what's your sort of feeling with those key metals from an Australian perspective? Yeah, I'm looking at the iron ore chart right now, and it's similar to a lot of those other base metals. We've had a fantastic fall, but we've been basing for a good 6 months now. So markets don't, rise and then, I shouldn't say that, they rarely rise and then collapse. It's not the norm. Everybody remembers those huge events, but they forget the dozens and dozens or hundreds of other times where markets go up, flatten out first, and then go down, and vice versa. It's pretty rare that something crashes and then rallies straight back up again. It falls, it flattens out, and then it starts to rise. And I like to say you go from a supply-side market to an equilibrium market where demand comes in to meet that supply, and then one of them's got to give way. So the question now for iron ore is who gives way. Does the supply give way, the demand take over, and we move back up? I think for the similar sort of reasons Ben said, that's an unlikely scenario in the near term. Do we get the status quo where we just bump along the bottom for a while? I think that's the most likely scenario. Or do we get a breakdown where we actually move lower because supply takes over again? And I think that is probably a more likely scenario than the up scenario. Certainly with Roy Hill coming on. I mean, Roy Hill's actually starting this month, and I think I'm not sure exactly what the figure is, but I think it's 80 to 90 million tonnes that's going to be producing within 12 months. Now, that's about 7 or 8% extra supply just coming on there to the world market just from the one mine, let alone what BHP's got planned and in train and Rio and Vale. So that would seem to me that that's a reasonably high scenario, that oversupply situation. Yeah, there's not a lot of the charts to suggest that iron ore is going to pick up in time soon, probably sideways. I think a key catalyst to the downside will be something worse happening in China. Like I said, we've probably got a bit of breathing space on that in the short term. Watch out for the US economy, because I think there are some serious headwinds there in terms of they've got to get those rates back up, but they can't. So I think the market will start to focus on that conundrum. Well, I think it was very interesting about 4 or 5 weeks ago when Janet Yellen gave her speech, and I think it was the first time that the market actually went down when Yellen was talking about putting interest rates back up. I mean, this time it's reversed again. But before it was bad news is good news, and that time it was actually like, well, do they really get it? Are they ever going to be able to do that? And actually bad news is bad news. So I thought that was a very interesting change in sentiment at that point in time. Now it's reversed, of course, now. It flips every week. I mean, the bad jobs number, the market rallies significantly on that number. I think if there is another global, another shock to the global economy, what's left? What other levers are there to pull? So, I think they need to normalise rates. I think they know they need to, and I think they will sooner rather than later bite the bullet and start to do that, regardless of what the data suggests. Good. Now, while we're on the sectors, gentlemen, banks. Well, I'm sure we get asked about banks generally or specific banks, but
Ben, what do you think of banks at these levels? I mean, banks have really been smashed pretty hard.
Yeah.
And we know why, because the capital adequacy ratios are changing, because, you know, APRA's trying to slow down the property market and being quite successful doing it. But it seems to me like they're starting to emerge a little bit of value in the banks. We've been very underweight banks for the last sort of year or so, but it's starting to emerge. I think it may be a bit of value at these levels.
Yeah, I'd agree. I reckon they look on the... I wouldn't say they look amazingly cheap, but I think they look on the cheaper side of fair value. And, you know, to me, the other story there, Ken, is the banks, I don't reckon, have got a lot of earnings growth over the short to medium term, so maybe over the next 1 to 3 years, as they're raising more capital, probably a bit of a rise in their bad and doubtful debt provisioning. Rates aren't going to go much lower. The housing market seems to be stabilising. Credit demand sort of dropping off somewhat. You put all those together and it's hard for me to see much in the way of earnings growth. So
yeah, it's hard to see more than 5% earnings growth, isn't it? You can maybe see sort of somewhere between the 0 to 5%, squeezing out on the cost side, but it's hard to see more than 5.
And I don't see a lot of dividend growth at all, because they'd be crazy to be raising capital and then increasing their dividends. It just wouldn't make sense. So
that's the big change really over the situation maybe 18 months ago, isn't it?
Yeah, big time. I mean, the banks had pretty solid earnings growth over 3 years. It's you know, share prices follow earnings. And so I think, to me, the banks, like, once the volatility dies down, I think you're going to start to see people looking at that 2% cash rate again and the 9% in gross income you can get on ANZ or Westpac and start to push back into those. But the thing I would say is that at some stage the Fed will lift rates, and if the last month has taught us anything, it's that we are part of a global share market. And it's pretty obvious, I think, to most people that, you know, quantitative easing has affected asset prices right around the world, including our banks. You know, the carry trade, to borrow money at 0 in the US and then get 6 in ANZ, as that every time, like 1 October last year we saw the taper tantrum. This year we've seen, you know, the first hint that the Fed are going to move has seen real ructions outside of the US, ironically, not within the US, and it's been in yield has been one thing. You know, Telstra and the banks, I've all got sold off because I think there's no earnings growth, and if interest rates are going up over here, then that yield to an American investor becomes less attractive, and so the share price is going to move down. So that's one thing I would say, is that they might be more, you know, more open to following what US rates are doing. But I still think, you know, you're getting 9%. If you get no capital growth in 3 years, that's still a pretty good investment.
Yeah, compared to 2.5% cash.
Absolutely. And I think you could see a bit more of a, you know, I think you could see CBA at $80 at some stage over the next year or two, plus an 8% dividend. That's a good return. So I'd be getting pretty keen on the banks here too.
Good. Okay, thank you, gentlemen. Now, we'll just go to a break now, but we'll be back with more of your questions in just a moment. If you'd like to speak to our expert panel, call us 1300 30 34 35 or email yourmoney@skynews.com.au. Welcome back to Your Money, Your Call. We're still taking your calls, 1300 30 34 35, and emails yourmoney@skynews.com.au. Now we'll flick straight to our first caller. We've got Anthony. Anthony's calling from Adelaide. How can we help you tonight, Anthony?
G'day, Ken, and thanks for taking my call.
Pleasure.
There's a couple of gold stocks I want to talk about, but before I mention which ones they are, I just want to say that every time someone comes on this show to ask about a gold stock, invariably the guest speakers usually say, oh, we don't like gold, and we don't know what the catalyst is going to be for the price to go up and so on. But while everything has been going down, gold stocks have been racing up. So I think they're doing their customers a disservice by not mentioning gold. Having said that, I just want to know, particularly from Carl, because I really love his way of trading, if he could give me an idea of where RMS, which is Ramelius, and Evolution Mining are going.
Not a problem, Anthony. Now, I guess the reason people are saying that about gold is because gold's very much in a downtrend. And, you know, whether you get a rally within a bear market or whether it's actually a rally in a bull market, it's quite a different story. for my mind, I wouldn't go anywhere near gold, so I'm sorry to add to the cacophony of people saying that at the moment, Anthony. But I will flick to Carl. Carl might have some other opinions on these stocks in terms of trading.
Well, gold's an interesting one. I mean, the gold price has been pretty flat to down over the last, 2 years. But the gold price in Australian dollar terms has not been flat because the Aussie dollar's obviously been coming down. So, local producers will benefit from that. And there has been a bull market of stealth in some of these gold stocks over the last 6 to 12 months. Ramelius has done pretty well. It's very much at the small end of the sort of spectrum that I look at. But in terms of the technicals, it does have a good trend since the start of 2015. It's got some good candlesticks coming in. What I like to see in terms of those Japanese candlesticks are nice white candles. Those are the candles that start low and finish high. It's a good sign that there's demand coming into the system.
Starting low and finishing high.
You can have candles that start well, go up, and then get beaten back down. They create these things we call shadows up the top, and they're a good indicator of supply coming to the market. Very few of those coming into Ramelius. It's mostly demand-side candles. The stock's outperforming the broader market, which is not all that hard to do if you've got half of an uptrend these days.
Certainly not from 5 cents.
Look, I think if you're on it, definitely stick with it. It's a little bit at the small end. The sort of gold stocks that I'm looking at the moment, Northern Star NST, I think looks tremendous and would be my absolute top pick in that area. In terms of evolution, that looks very prospective as well. A little bit of overhead supply potentially coming in at $1.50. A few people probably stuck in that stock for a while, looking to turf some out there. But if we can get through that, then there's really nothing holding it down to $2, and there's nothing on my charts to tell me that it can't do that. So evolution would be my pick over Ramelius, and probably Northern Star my pick over both of those.
Good, thanks, Carl. That's great. Now, Ben, just talking about the gold price, I mean, I guess one of the things that might have helped the gold price out in the last, week or so, in particular, was the US putting back their interest rate rise.
Right.
It's going to be very difficult, in my opinion, over a 1 or 2 year period if US is putting up interest rates and their currency is actually going up. With gold, denominated in US dollars, I think it's going to be very, very hard for gold to go up, against the US currency. It never has in the past. Do you have that similar view, or have
Absolutely.
you got? Yeah. Okay.
Look, I don't quite get what Anthony's saying there. I mean, the last 2 years, the gold price has fallen from $15.
Well, I remember Ramelius was $2, wasn't it, 3 years ago or thereabouts?
Yeah, I mean, this has been a terrible sector to be invested in. Yeah. It's been a great sector to be invested in the last 3 to 6 months, but if you look back to the last 5 years, this has been like Newcrest was $44 3 or 4 years ago. It's now trading at 13. That's was the biggest gold producer in Australia. So I wouldn't agree at all that you're doing a disservice to clients by saying avoiding it. Avoiding it to me has been a great decision. I think the reason that you're seeing the recent euphoria in the gold price is down to two things. A lot of the producers, when the gold price fell through the floor, had to very rapidly get their costs under control, and they're now producing on much leaner cost bases, and the gold price has since stabilised, which has meant that there's some margin there for them. But B, and more importantly, the Australian dollar has fallen 30% over the last year.
It's helping them a lot,
and so an Australian dollar gold producer has gone from making $1,100 an ounce to 1,600 Aussie an ounce, and suddenly they're making great margins. So that's good. But A, how much further is the Australian dollar going to fall? And B, is the gold price going to hold when the US start lifting rates? And I can't see it.
I can't see it either.
At some stage, the US dollar has almost a perfect negative correlation with the gold price. And once you're an investor and you can get maybe 1 or 1.5% return, doesn't sound like much in cash versus zero, the cost of holding gold starts to rise. And it would also signal if US are lifting rates that the world is becoming a safer place. They're trying to slow down their economy by doing that. And that would suggest to me that the safe haven of gold, which, we've just gone through a very volatile period the last few weeks, that's probably helped fuel gold demand, but I think that will taper away.
I think, in our opinion, at Financial Clarity, we think that compared to the rise in the US dollar this time over the last year, compared to previous rises in similar circumstances, we're just at the start. We just were looking at the 80 to 85 period. It actually rose 4 times more than what it has so far against the trade-weighted index during that period, and almost every time that the US has reflated. Now, it might not rise quite as much this time because they probably won't reflate as hard, but compared to the rest of the world is easing their currencies. They're actually quantitative easing Japan, quantitative easing in Europe, and the US would be the only country that has stopped that, apart from Australia, has stopped that and is actually raising rates. So it could go a lot higher over the next 2 or 3 years. So just something to think about in terms of your overall strategy. Now, we will go to another caller. We've got Gus calling from Sydney. How can we help you tonight, Gus?
Good evening, gentlemen. Thank you very much for your time.
Pleasure.
I appreciate it, and you sharing your professional opinion. Firstly, I've got a question. You were mentioning earlier banks versus interest rates. I have a small portfolio, but besides investing in banks, what other area or sector would you recommend investing in?
Okay, yeah, good. Thank you, Gus. Well, Ben, I might flick to you here because I know that you're invested very broadly across, a number of industrial stocks, not so much in the resource sector at this point in time. But what are some of your favourites at this point in time?
Sectors is probably something I pay a little bit less attention to. It's more trying to find, businesses regardless of sector. But healthcare has been our biggest overweight for a few years now, and probably remains so. Healthcare and infrastructure would be the second probably most heavily invested sector across, if you pick out one sector across clients' portfolios. Like healthcare, I think we would all understand why, it's a nice place to invest at the moment. It's one area of our market I think we really punch above our weight in terms of having truly great global businesses that are growing their profits, leverage to a globally ageing population, increase healthcare spend. And, to me, that's an area that I still think offers great potential.
A lot of those companies also have US dollar or
US dollar earnings. Yeah. The problem is I'm not the only one that thinks that. A lot of people think that, and it's hard to find good value. But, like if I was saying, like the biggest holding in portfolios of mine is CSL still. And I still think that despite what people say, I still think it looks pretty reasonable value. And it is going to have a year of earnings consolidation this year. It's investing heavily into 2016-17 when it's got 2 new drugs that will come to market. But then there'll be a springboard, I think, into the next few years. And I think it's a great stock to own if you're looking for something outside the banks.
Excellent. Carl, just quickly, 1 or 2 sectors, and we might then drill into that in more detail after the break.
Yeah, sure. In terms of looking at the technicals, there aren't any sectors which are looking that great anyway.
Right.
But there are parts of sectors. I'm interested in within the consumer discretionary area, Aristocrat Leisure. I think it looks very, very good, and so does Ardent Leisure for a bit of a turnaround play. And I think Crown is probably at a level where you can start to get back in. So you've got 2 gaming stocks and a theme park there. All will benefit from a lower Australian dollar. One of them, the theme park, will benefit probably from improved economic growth on the East Coast, certainly not out of my state. Apart from that, as a speculative play, Ben touched on energy before. I think we're probably very close to the bottom on energy. At the very least, you've got a very logical stop loss. If you're going to take a speculative trade here, we'll stop beneath those lows. So some bottom fishing there, perhaps.
Well, if we have some spare time during the course of this evening, let's explore those areas a bit more. Now, we'll be back with more after the short break. If you'd like to speak to our expert panel, call us on 1300 30 34 35 or email your money at skynews.com.au. Welcome back to the program. I'm Ken Bloomfield from Financial Clarity, and with me on the panel tonight is Ben Clark from TMS Capital and Carl Capolingua, I'll say it again, Carl Capolingua from Investor Systems. We're here for another hour answering your questions on shares, so if you have a question you'd like answered, call us on 1300 30 34 35 or email yourmoney@skynews.com.au. We'll flick across straight to our next caller, who is Roger. Roger is calling from Melbourne. How can we help you, Roger, tonight?
Thanks for taking my call. I'm a retiree, and recently, because of the share price falling down, I sold all my shares, and I'm started to buy them at least twice, and again losing money only. So I would like to start buying some income stocks, including banks, Telstra, and any other things. Is it the time to enter the market, or should I wait for a little bit longer? Can you kindly advise me on that, please, both from fundamental and technical point of view?
Okay, thank you, Roger. The first thing I'll say, Roger, that's a pretty extreme reaction and maybe an extreme strategy to get totally out of the market and totally into the market. So just be careful with that one in terms of, you can get whipsawed around the place with that type of strategy. We would certainly recommend more, unweighting and weighting through the market and through the sectors rather than taking such extremes. But having said that, I will flick to Carl to talk about the banks, buying into the banks. If you were buying in at the moment, which banks would you buy, if any?
No, I think it's a more of an if any. No, I don't think the banks are the best place to be right now if you're looking for capital growth. But it really is a horses for courses. So if you're purely after yields, and over the years, as much as I've tried to convince people that that's not the be all and end all, there are some people out there with $1 million in their super, and they just need X amount per year to get through until the day they leave this mortal coil, and they're happy with that. And if that's your objective, then I think the yields at these levels are far better than they were a few months ago, and that's all you really need to know about the banks. Really, is if you're using that sort of reason for investing. If you are after capital growth, and my clients invariably are after capital growth, then no, I don't think this is the best place to be. I'm not seeing any signs at all which tell me that the money is flying back into this sector in any meaningful way at this stage, and therefore it's far too early for me to be recommending clients bottom fish in that area. You will start to know when that might be the case when you start to see some really sharp moves up on some good volume coming into that area, or the stocks in that area. We're not seeing that yet. As mentioned before, I'm starting to see some of those signs come into some of those energy stocks, so maybe that's another place to look. And well, I was going to say some of the yields there are pretty attractive, but that's only if you believe in fairy tales that dividends will be maintained.
Stay forever.
Yes.
Like those fairy tales about the iron ore stocks that were paying the 6 or 7% 3 or 4 years ago.
That's right.
Ben, what do you reckon? We've spoken about the banks already a bit tonight, and we've basically said that they're entering a sort of evaluation area where they're interesting now at this point in time, or certainly a bit more interesting. But as you were saying before, it's very hard to see any growth out of that. It's if you're there for yield, fantastic. I know NAB's now trading at about 9.5% grossed up yield, which is wonderful. And it's probably the bank of pick for us at this point in time. But even CommBank is starting to get back down to levels that look reasonable.
Yep, I'd agree. I think one thing I'd just say to the caller is, when you're sort of saying, should I get in now or should I wait a little bit? No one knows. I've got no idea. That is the absolute truth, isn't it? No one knows. It really is the truth that I've got no idea where the market will be next week, next month, or in 2 months.
So I say sometimes I have a pretty good hunch, but right now I can honestly say I don't know. It's that uncertain right now. So it's a crazy time to be doing what this call is doing, which is flip-flopping in and out of the market.
Yeah, I'd agree with that. Like when the banks, when CBA got down to its capital raising price, I would probably been stronger that is going to have a rebound, because inevitably you see that a lot of the time a company issuing capital comes back to the price it issues at, and then
often 2 or 3 times before it moves.
But I still would say that trying to trade in and out whilst looking for income just doesn't make sense, because you're inevitably at some stage you're going to miss the run and you end up chasing a tail trying to work out what to do. But the banks, as I said before, I think look fairly reasonable value, but we have a view that the banks will pretty much range trade over the next 2 or 3 years. And I think there'll be periods over the next 2 or 3 years where the bank share prices could be 5 to 10% higher than where they are now, and there could be prices where you see where they were a few weeks ago. And I think really strong dividend support kicks in at those sort of levels, and I can't see them going too much lower. So you'll get a great reliable income, I believe, and you'll also probably get the chance to reduce down somewhat that banking exposure at better prices and maybe add to a bit of it. Just like you're saying, Ken, I'd back that, you know, sort of going with the flows of the, you know, where you feel valuations are. But that'd be my thoughts on the banks.
Good.
I'd say NAB looks the best of the banks. So they'll hopefully finally float off the UK banks, and I think there could be a re-rating there. And CBA is the other one for me, which is the, you know, the highest quality bank.
Okay, good. We're in alignment on those two. I think ANZ's going to have a little bit of trouble, in our opinion anyway, with their Asian businesses. It's going to be really tough in Asia for the next couple of years, in our opinion, with a inflating US dollar in particular. So there we go, Roger. There's some thoughts. The one thing I would say on strategy is that from the clients that come to see us, I would say that probably about 1 in 50 has a written investment strategy, if that. And I really think that you know, getting the strategy, portfolio strategy right, is a very, very large component of being a successful investor, and because it helps guide you in circumstances like we've had in the last month or so where it's very volatile. To that end, we actually ran a seminar on portfolio construction in a slow economy near the end of August, which if anyone's interested in that, just jump onto our website, financialclarity.com.au, go to the media page. There's a 40-minute talk from me, which our clients received, and we actually had a number of people from this show who also attended in the city, in Sydney, and you might just get a few hints there about constructing a robust portfolio, one that will, you know, work through the cycles and still do reasonably well. Now we'll move on to the next caller. Next caller is Ben from Brisbane. Ben, how can we help you tonight?
Thank you. Just after a technical on transaction solutions, these guys are rolling out ATM machines in India. They're approaching 100 million transactions a year. So just after the thoughts, thanks.
Good, thanks, Ben. Now, Transaction Solutions International, code TSN. Certainly not one that's come across my radar. It sounds like it might be a bit smaller. Carl, we might flick to you on this one.
Okay. Yeah, look, it's a little bit tough.
In the hot seat.
In theory, you can do technical analysis on anything, right? This one's particularly hard. There's the charts on screen. It doesn't really...
looks like it's got no liquidity at all.
Yeah, it doesn't give you a really broad picture of how it's been going, but it's been bobbing around between 0, of course, can't go any lower than that, and about 1.5 cents for the better part of 5 years. So it hasn't done much in the recent past to suggest it's going to do anything differently. I think I'm going to stop there. I regret I can't give you more information, but there's just not enough supply and demand interaction for me to use any of my systems on this one.
Okay, right, we'll move on. It's better not to give an opinion if we're not sure about things, or we don't have a strong opinion on things. Now, we'll move on to an email. We talked about the banks, and we of course now have to talk about Telstra, because it's one of the favourite stocks in Australia. We've got an email from David who asks, considering recent mergers such as TPG and IONNet, it seems that the telecommunications sector is generally increasingly competitive. How will this affect Telstra? Excellent question, Dave. Telstra, interestingly enough, after the announcement of the deal between, not the TPG and IONNet deal, which happened a little while ago, but the deal between TPG and Vodafone, I thought it was really interesting, Ben, to see Telstra come out and saying, we are going to compete on price. Now, I don't think they're only going to selectively compete on price, I would imagine, but you know, Vodafone's demise and in fact implosion really in Australia has been a wonderful boon to Telstra shares in the last 2 or 3 years.
Absolutely. I think the first thing I'd just say on the callers, also the email that the viewers sent there, is you've got to bear in mind that IONNet and TPG don't have a decent mobile phone business, which is still the majority of Telstra's business. So yes, on the ADSL side, this is becoming a much more competitive industry, but both those, TPG really lacks a decent mobile business, and I think, you know, David Teo sort of lamented that they'd love to have one to cross-sell to their existing loyal customers, but they don't. So Optus, which has been investing very heavily into its systems, and Vodafone, which is voted fail, but seems to be coming back now. Also been investing heavily, and they're the main two competitors for Telstra. If you go back to August, you remember that there was a very sharp sell-off in the price of Telstra, and it came down to one sentence that Andy Penn mentioned on the analyst call, which was, "We will defend our market share at any cost."
Yep.
And what the market took that as meaning is we're going to reduce prices if we have to, and that is a bit of a worry, because if Telstra, you know, they're not going to get any new customers. They got a million Vodafone customers came to them in 2 years. They're now going back in some cases to Vodafone or to Optus or to other providers. And so if there's no new customers, the only way you can make money is if you're lifting your prices, but it actually looks like they'll be reducing them. Yeah. So they need to find other areas that they can make money. Yeah. It's not going to be ADSL, because I can promise you TPG is going to keep taking market share. And, you know, I think Telstra's in a bit of a bind, but I don't think that business is going to fall off the side of a cliff. I think that the dividend's pretty sustainable, but it all comes back, and, you know, a lot of people on the show have been saying there's just no earnings growth in Telstra. There was a yield bubble. It got to a bubble at the start of this year.
Now maybe it even looks like there's less earnings growth on Telstra with that comment.
Right, and you know, the dividend yield is not going to push the share price up. It might get back to $6, but I don't think it's going to go too far beyond that.
Well, the interesting thing with Telstra, just to keep in mind, and we're certainly not overly negative on Telstra, we're sort of neutral on them, but the interesting thing to keep in mind is their dividend payout ratio is in the 90s, I believe. Yeah. It's very, very high. So it wouldn't take much of a change in earnings for them to have to certainly not progress their dividend anymore like they have been. The NBN will probably help them do that in the next couple of years, keep on progressing their dividend a bit. And like BHP, maybe they might even reach into the coffers and pay dividend out of earnings that might come in the future or borrowings. But I think that the game's changed a little bit for Telstra.
Yep. I would agree. The positive note with Telstra is they are flush with cash.
Yeah. Huge and the NBN earnings are going to keep on flowing through for the next couple of years.
So the balance sheet's very strong, and the business is strong. So don't rush out and sell Telstra shares. I just don't see the future in it that I see in other businesses.
Yeah, and I think that compared to a year ago, I think that has changed a bit. What do you think, Carl? You know, both technically and even just from a business perspective with Telstra.
Yeah, look, I think from a technical perspective, we've hit a bit of an inflection point here. They've had a pretty big sell-off since August, has been said, but really the selling started back in February. Once it cracked, it couldn't get back up again. We went from that demand side equilibrium, now in a supply side market. A little bit of demand coming around here, but certainly nothing really convincing me that it's time to get back in. I'll leave the comment on the Telstra business to Ben. Technical perspective, I wouldn't buy it, and if I had it, I'd be looking elsewhere.
Okay, good. Thank you, gentlemen. I hope that helped. Now we're just going to take a short break now. We'll be back to answer more of your questions in just a moment. If you'd like to speak with our expert panel, call us on 1300 30 34 35 or email us at yourmoney@skynews.com.au. Welcome back to the show. If you have a question you'd like answered, pick up the phone, give us a call on 1300 30 34 35 or email yourmoney@skynews.com.au. Got plenty of callers here, so we'll go straight to Helen. Helen's calling from Sydney. How can we help you tonight, Helen?
Oh, good evening, gentlemen. This is just a follow-through the gentleman that rang earlier about gold stocks. I'm ringing about St Barbara, SBM. I bought in a couple of weeks ago at 73 cents. It ran all the way to $1.16 today. So with all due respect to you guys, lucky I didn't listen to anyone. I just see, I know you guys say, oh, if the Fed raises rates and so on, but there's so many other problems in the world. You've got China, Middle East, like, you know, anybody can sneeze. Next thing we're in trouble, and I thought gold is the go-to metal. So I was wondering Carl's opinion on the chart for SBM, please.
Good, thanks, Helen. Yeah, Helen, I guess it's all about time frames. If you want to trade a stock like St Barbara, obviously there's been a good opportunity to do that in the last 6 weeks, but maybe call back in a year and we'll see where gold is and where SBM is in a year, but who knows. Carl? SBM?
Look, it's another one of those bull market by stealth stories, SBM, amongst the many other gold stocks. And
screamed up, hasn't it?
And Helen was, talking about this idea of this problem in the world, so go to gold, and gold price hasn't actually moved in US dollar terms. So I'm not sure if that argument holds water, not to say that there may be some catastrophe and it might move down the track. I think it's a different story for gold stocks. And gold stocks, in my opinion, maybe you might have an opinion, Ben, as well, are notorious for not moving in sync with the gold price.
Yeah.
Quite often.
Yeah.
And I think that's just what we're seeing here. Again, we've talked about the Aussie dollar price of gold, which local producers are enjoying, of course. St Barbara, from a technical perspective, looks wonderful. I mean, I can't fault this chart. It is the absolute stairway to heaven over the last 3 months. There's absolutely nothing in my charts in terms of the volume, the price action, the candles, which would suggest that that run isn't going to continue. So I can't even say that you take profits here. One little thing maybe is that if you look at its tendency to move up, so if you look at it sort of, you plot its average up moves on a standard normal curve, this one is over 2 standard deviations away from what it would do on average. So that would suggest, 98% of the time it doesn't go much further than this. I would play this one by ear. So I think whilst the technical signs are good, you've got to stick with it. Start to use a stop loss. Don't be one of those heroes that buys a stock at rock bottom, holds it all the way back up, all the way up, and then holds it all the way back down again. I'd almost be so bold to say that put your stop loss 1 to 2% beneath each candle's low. So each day, get on the ASX website, see what the low of the day is, work out a couple of percent.
Protect that profit.
Just to protect that, because it's in this this vertical move up, and who knows? You're crazy to think I'll take profit now because I'm making money. Never do that. Who knows how much could go? But if you put in a little stop loss like that and it keeps going up, you get the benefit of that. If it starts to move back down, you're out, because it has had an extraordinary move in terms of its moves, its tendency to move.
Just to put things in perspective with St Barbara, I don't know if you got it on the chart there, Carl, but where does St Barbara come from at their top?
Oh, okay. Well, that's an interesting question. Let me zoom.
Because a lot of these,
been as high as 5, as low as 10 cents.
Right. Okay.
So at the start of the year,
$5 to 10 cents,
and back to $1.10. So
okay.
if you put
that's the sort of volatility we're talking about. Fine if you're trading the stock and if you get on the right side of that, but otherwise lose your pants and your t-shirt.
I don't think you put 10% of your super fund in St Barbara.
Yeah. Okay. Good. Now we'll go to the next caller. Thank you for that, Carl. We've got Ray. Ray's calling from Sydney. How can we help you, Ray?
Good evening, panel. I'm just making an inquiry on what the panel's thoughts are on Virtus Health.
Virtus Health?
Yes, I've just noticed profits are up, their net assets are pretty strong at the moment, and they're in a favourable industry. Do you think it's a good time to purchase some more stock? I just really wanted your opinion, guys. Thank you.
Thank you, Ray. Now, I might go back to you on this one, Carl, first, unless have you got an opinion, Ben?
I do actually.
Fundamental perspective?
Yeah, I've actually done a bit of work on this stock and this industry. I've spoken to people in the industry, some obstetricians and the like. I spoke to them because I agree with you. I really like the themes of this sector. Women are choosing to have babies later in life. That's just a generational change, I think, is occurring.
Yep.
And they subsequently need help in doing that from companies like Monash IVF, Virtus IVF, Primary, and there are some unlisted ones out there as well. The only thing that stopped me from purchasing, I would say the August result was good, but the thing that stopped me from purchasing is 2 things. Firstly, the industry is becoming a lot more competitive. Now, if you speak to people in the industry, they're saying that Primary are aggressively going into IVF and offering rates much cheaper than Virtus and Monash. Right. Now, I think that's frustrating them because I think the view is that Primary don't provide nearly the quality of service and advice that you'll get at somewhere like a Virtus, but it's a much cheaper option and it is a very expensive thing to go through, and people are going for the cheaper option, which is putting some pressure on Virtus in terms of costs, and also, because they pay doctors' salaries. We've seen this in a number of stocks in this medical industry. Doctors are something you've got to be aware of. You know, the salaries are high and they don't like taking pay cuts. Secondly, we have an incredibly generous IVF program in terms of government funding in Australia. Like an obstetrician I spoke to said, compared to the rest of the world, it's unbelievable. Women can have as many cracks at getting pregnant as they like, and the taxpayer will subsidise a large part of it. In most other countries, you get a certain number of tries and then you have to start paying for it yourself. Or if you leave till you're 40 or something, then you have to pay for it yourself. And given the government's trying to find ways to cut costs, this could be an area that they target. And they did try and target about 2 or 3 years ago. They decided not to, but it could come back. So for those reasons, I avoided it.
Good. Okay, thanks, Ben. That's a really good sort of background there to the industry and the stock. Now, the code is VRT, so I think we had a different stock up on the screen there. But technically, Carl, what do you think with Virtus?
I don't think it looks very good. Look, there's nothing screaming at me that you should sell it if you've got it. It's probably a hold with a stop loss around about $5. If you look at it from that perspective, you've got 40 cents worth of downside and unlimited upside. But I think it's one, given the technicals, to have some risk protection in place. I wouldn't buy it here. I can't see anything. There's nothing here. Price action, candlesticks, there's volume. There's nothing here telling me to buy it at this stage. Okay. In the healthcare space, EHE was one that came up on my scan today.
So STR?
I haven't had much of a chance to do much more research into it than mention that the chart looks fantastic at this level here.
Yeah, so. Good. Okay, fantastic. We might talk about STR after the break, but it is time for a short break now. We'll be back with more of your calls in a moment. 1300 30 34 35 if you'd like to talk to our expert panel. Welcome back to the program. On the panel tonight, answering your questions. They don't look it, but they're veterans of this show. Ben Clark from TMS Capital and Carl Capolingua from Investor Systems. I'm Ken Bloomfield. I do look like a veteran. The grey hair from Financial Clarity. We're here for another half hour or so. Plenty of time to give us a call, 1300 30 34 35, or send an email to yourmoney@skynews.com.au. Now we have Andrew calling from Brisbane. Andrew, how can we help you tonight?
Yeah, g'day, Ken. CSL's been moving in a sideward direction and a downward, not a spiral, but a downward trend. I'm just wondering if this is it'll break to the downside and buy it at a lower level.
Okay, yeah, thanks, Andrew. Good question. Yeah, I think the result for CSL, we actually used the results as an opportunity to actually buy some CSL, because the market was a little bit disappointed in some ways, because CSL said that their earnings were going to be pretty flat in the next 12 months because they were reinvesting a fair chunk of money back in the businesses. And as Ben actually mentioned earlier, they've certainly got some products coming out in 2016. They're talking the 2016-17 financial year, which will, potentially kick their earnings back up to the next level. But maybe we can go to you on this one, Carl, before we get a backfill from Ben on the fundamental side, because the question Andrew was asking really is, with that price action, are we into a downtrend, or is that just an adjustment from that big peak that we saw in the second quarter?
Yeah, I think also Andrew's trying to make a trade here. Basically, if I've interpreted it right, he's owning the stock, and can I sell now, maybe buy it back a bit lower? And I think it's 50-50 from here. And personally, I don't like 50-50 bets in the market. I prefer a 51-49 over a 50-50. And in terms of the technicals, CSL, it's really flatline. I mean, really could go either way. We've got nil price action. Candles are, black, white, intermittent. There's just as much, pushing up and being brought back down as there is going down and holding a level. There was a little bit of volume that came into the stock in that sort of mid-August low, which is encouraging. People are prepared to dip their toe in the water there, but normally to be confident that the stock is going to rally quickly off a level like that, you would expect to see the price move up quite rapidly after that volume has come in. It hasn't done that. It's flattened out. The demand's come in. the price has gone flat can only really mean one thing, and that's suppliers come in to meet that demand. And I'm sure there are a bunch of funds out there that are sitting on some pretty nice profits on CSL that are maybe just there's a bit of a changing of the guard here. Now, the question is whether we do break that support level at 85 and move more into a supply-side market. Then we could see a move back down into the 70s, or whether we hold here is probably the most likely scenario. So I don't want to be a trader on this either way. If I had it, I would sell it simply on the basis that I think there are better opportunities out there right now.
Okay. Ben, it's interesting, isn't it? Because there are some very good reasons why the chart, I think, is looking like it is, and that is that I think investors are a little bit disappointed that the earnings, weren't flowing through a bit faster. They were a bit, I think, short-sighted maybe. We saw this with Seek as well during the earnings season, also looking to reinvest in the business, got a negative price reaction initially. And Carl might well be right that there are probably some fundies sitting on some big profits there saying, should we wait around for another 12 months until the earnings kick back up, or should we just get out of it now or reduce the exposure? But for my mind, I'd see this, any weakness in the price as an opportunity to get into the stock, particularly if you've got a view that the US dollar is going to keep on appreciating. Do you feel that way as well? Or are you a little bit more sanguine about the price short term? Oh, look, short term, I suspect the share price will continue to consolidate because I think earnings are going to Feels like that, doesn't it? Yeah. But the one thing I picked the caller up on is don't be too short term. It's not a criticism, like we all look at share prices every day, but this stock has gone up $20 in the last 12 months. So that's from $70, that's a return of, sort of 27, 28% in the last year. It wasn't long ago that CSL was $25. Right. I mean, that's a phenomenal year. I think the stock's sort of tripled over the last 4 or 5 years, which has been amazing. So don't look at the last 3 or 4 months and think because it's gone sideways, it's not doing that well. At some stage it had to take a breather. It's just been phenomenal. Yeah. My view is that the stock will consolidate for maybe, I don't know how long, but maybe another 5, 6 months. Maybe there will be something else better to be in during that time, but at some stage the market will start to factor in 16, 17 earnings, and we don't know when that'll be, but the market will do it itself. And the guidance from the company is that they will start to move quite strongly higher. And this is probably one of the most frustrating things I found in reporting season is companies that said we're going to invest for future growth got punished. Because that's just not what should be happening. If you're a long-term shareholder in a business, you want to see companies It's a sign of good management. Right. And you don't want management to be looking 6 months ahead. You want them to be looking 6 years ahead and trying to see where they take the business to there. And if they do it well, you'll be really well rewarded as a shareholder. So stick with it. Good. Thanks, Ben. And Carl. Now we'll go to our next caller. We've got Russell calling from Queensland, Toowoomba. Russell, how can we help you tonight?
Yeah, thanks, Ken, for taking my call.
Pleasure.
The question tonight is on Automotive Holdings Group, AHG.
AHG, yeah.
They're Australia's leading new car retailer. They've got a good yield of about 4%, and there's been record new car sales each year for the last number of years. Look, I'm just interested in their prospects going forward, and share price has pretty much been going sideways for the last 12 months or so. Also, the significance of AP Eagers, who's number 2 on the list for car retailers in Australia. Any significance of them being on the AHG share registry?
Yeah, good.
Thank you.
Yeah, thank you, Russell. Yeah, good. Automotive Holdings been a great stock over the last 10 years, as Russell said. Car sales in Australia have been going gangbusters. Slowing down a little bit now, and I guess there's a bit of a view that with our dollar dropping so much, and of course, all the cars, or almost all the cars being imported, certainly all the cars will be in a few years, that will add to the price and maybe slow things down a bit in terms of car sales. Ben, is this one that you follow?
Yeah, we've looked at it. I think it looks pretty cheap. It's trading on about 13.5 times earnings. I don't think there's a huge amount of earnings growth there, Russell, sort of high single digits, but it's a great business. They'll probably do a few bolt-on acquisitions over the year, which could sort of see, sort of low double-digit earnings growth. And the car prices will rise, but financing's still very cheap. You know, I think if you can get someone into a car at 3%, 4% financing, people worry less about what they're paying for it.
Yeah.
So I think the outlook's still pretty good for them. APE has been on the registry for years, and they're using creep provisions to just keep creeping up that register.
The 3% a year, isn't it?
Yeah,
3% a year,
it's 1.5% a month, every 6 months.
6 months.
So that's Nick Politis' company, of course. So it's going pretty well. That's actually been the better of the two to be in, by the way. And but I think this as a hold and on dips probably a reasonable buy.
Okay, good. Carl?
Any exposure, Ben, to the Volkswagen? Any Volkswagen dealerships within their
portfolio? They came out and announced, I think, that there was 80,000 cars that have been affected in Australia by that. So
80,000?
80,000, yeah. Mostly from the Golf, but also Skoda?
Skoda, yeah.
Skoda, yeah.
That's a good point.
I mean, you can't sell a diesel Volkswagen in Australia right now, so it's got to be hurting those dealerships. Who's to say whether they have those dealerships in their portfolio?
These guys are very, very well diversified. I know that across a lot of the different car brands, but I'm not sure what their exposure to VW is. So interesting point, Carl. Thank you.
I would suggest that if they had a significant exposure, the share price would have plummeted. Over the course of the last couple of weeks. It hasn't happened, and that's an example of, I guess, the technicals following the fundamentals. Maybe it's the chicken and the egg, but no, look, it's not knocking my socks off. It's really flat to middling. It's at the bottom of a pretty well-defined range between sort of 390, 460. If you want to play the game of trying to pick the bottom of that range and then get out at the top, I'll leave that very much to you. It's not my game. I would have to avoid, if I didn't have it, on the basis that I think there are better momentum plays out there. And if I did have it, you've got a very natural stop loss below 380. So that gives you 20 cents worth of downside and unlimited upside.
Beautiful. And you've segued beautifully into our next email, which is from Jim. Jim says, what do you think of the gradual rise of Slater and Gordon recently, and do you think that will continue? Talking about stocks that are trending up. Slater and Gordon was certainly trending down a few months ago and had a bit of a tough time there. It seemed like they hit a bit of a bottom and put a bit of a spike in at that bottom, and then they were chopping around about that sort of mid twos to high threes. High twos. Looks like it's just starting to get a bit of support there, but Ben, for my mind, this is one I'm steering well clear of until they sort out some of these accounting issues. I don't know about you, Carl, from a technical perspective.
From a technical perspective, there's nothing in here telling me that this is a good time to be getting into the stock. Never buy a stock on the basis that it's a third of the price it was 12 months ago. It's never a good reason to buy a stock. It's there because something's caused it to be there. So in terms of the technicals, it's still trending down. It hasn't built up that base pattern. Often when you see stocks that fall sharply like this, you've got that 6 months of doing time. It hasn't done the time. If I owned it, I'd be selling it because I think there are better opportunities elsewhere. If I didn't have it, I wouldn't touch it.
Okay. Ben, any comments? Slater and Gordon?
It looks really tempting. To me, it looks seriously cheap. And,
it does look cheap if things are all okay.
And I reckon we've met the company, and I reckon he's quality. The guy that's running it, his name's just escaped me, but this has all occurred because hedge funds are circulating rumours about irregular accounting practices. ASIC is doing an investigation. This is the second or third they've done. The first two, they came away no problems into how they account for their revenue and profits. And the market's concern is they bought a very big business called Quindel, using that.
Quindel had a bit of a nasty smell to it, though, didn't it?
It did, but they were well aware of that going in. It's not like they've sort of found that out post it. The company was basically...
Maybe that's why the rumours have stuck so much, because of the Quindel's background in the last 2 or 3 years.
Look, it's a tricky one to call, Ken. I say to the caller, there's two catalysts. First, ASIC imminently will give their thoughts on the accounting practices, and if they're complementary, I think you'll see a big short covering rally. And number two is longer term, which is, do the Quindel cash flows and profits that Slater and Gordon have told the market to expect actually occur? And if they do, there will be a really big re-rating of this stock.
So this is a bit of a binary outcome.
Right. And you've got to be careful. You wouldn't have too much money in it. But
you think there's some...
If you're looking for a punt, there's worse things to punt on, I reckon.
Okay. Excellent. Good. I haven't heard that from you for a long time, Ben, so if you're looking for a punt... Now, we're taking a short break, but we'll be back to answer more of your questions in just a moment. Welcome back to the program. If you have a question about a stock or shares, give us a call on 1300 30 34 35 or email your money, skynews.com.au. We'll go straight to our next caller. And the next caller is John. John is calling from Melbourne. How can we help you, John?
Yeah, I'm making inquiries about Monadelphous, or MND. I'm looking at putting about 1%, putting about 1% of them into my super, and I wonder if they're a long-term buy or an avoid.
Yeah, okay, good. Thank you, John. Good question. Monadelphous has been was a real darling of the market, certainly quality management group. John, my straight answer would be not yet. I think we've got a lot further to go in terms of the CapEx downturn in Australia. I think at some stage a company like Monadelphous will be a good buy. In my opinion, we're nowhere near that at this point in time. But, gentlemen, I'd be interested in your opinions. Ben, from a fundamental perspective.
It's interesting, like I was looking at it in August, because we used to be in this stock years ago and got out of a few years ago as well. But, like, the management are top-notch.
Yeah, are they getting any of the infrastructure spend, or are they likely to get much of the infrastructure spend?
They're moving toward it, but it's slow. And
there's not much coming through, unfortunately. It's been very, very slow.
A lot of talk, but it's not actually happening, is it?
Our ex-infrastructure Prime Minister, who dubbed himself the infrastructure Prime Minister when he came in, unfortunately, he wasn't able to really rally any spending in the infrastructure area for various reasons.
Mike Baird done a lot more in New South Wales.
Yeah, indeed, yeah.
John, I would say firstly you're being very sensible in terms of your allocation, because it is at a speculative point, but I reckon you're bang on in sort of saying 1%. That sounds about right to me, and see how it goes. The thing I draw to your attention is they've had a pretty decent contract dispute with, I think it's the Wissett coal terminal, which I think is about $150 to $200 million dispute over costs. Now, Monadelphous have an amazing balance sheet with no debt and plenty of cash, but if they were to lose that dispute, that would pretty much wipe out their cash balance and put a lot more pressure on the company. The backdrop for the company is still not good. I mean, they do a lot of work in the oil and gas space. We all know what's going on there. They used to do more work in resources. We know what's going on there. So they're the best operators in an industry that's doing it very tough, and there is some chance that good balance sheet isn't so good all of a sudden. So, but it looks very cheap. Like, to me, I think it's trading about 4 times earnings, and there'll be a point you will want to buy it again, and you probably won't be until you look back that you think that was the time to buy it. Now might be the time. So, I wouldn't be against it.
Okay, good, Ben. Carl, now you're a Perth boy, and Monadelphous is over there, just across the bridge. Not sure which bridge it is, actually.
The Narrows?
Narrows, across the Narrows. There you go. I haven't been in Perth for a very long time.
It's a spectacular bridge.
Yeah, it is indeed, and it's a spectacular city and everything. But Monadelphous, what do you think? Is it too early, or?
Yeah, I think it is. I think it is too early. It's certainly not the worst plummeting stock I've ever seen, but it's still got a bit of plummet about it. But
it's quote of the day, that one. It's still got a bit of plummet about it.
It's taking a little bit of a breather. I just want to see somebody put their money where their mouth is at this stage. So last time I checked, the only way it can go up is if there's some pretty serious capital inflow into your stock, and you'll know that's occurring either by the share price going up on very low volume over a long period of time because they're buying it very slowly, or it goes up sharply on a big whack because they've started to come in. I'm not seeing that. I just can't see the capital coming into this stock at the moment. At the same time, the selling has dissipated as well. So I look at it, there's just this malaise about the stock. So I think there are so many other better opportunities, more pressing opportunities than this one right now. So it's not one I'd be putting any % of my portfolio into at this stage.
Good. Okay, thank you, gentlemen. We will move on to Barry, talking about wonderful Western Australia. Barry is calling from Bunbury, great little town down the south of WA. Barry, how can we help you tonight?
Yeah, good evening, Ken. Bunbury is now no longer a little town. It's a city. It's a city.
When I said it, I thought immediately that's not true anymore. When I was a kid down there playing some golf, it was, but these days it no longer is.
That's it. Listen, I've got two questions. One on Crown Casino and one on Qantas. Crown, I've watched come down from fairly high teens right down to about $10. It's on its way back up again. I'm wondering whether it's a buy at this stage or should we leave it alone? And Qantas, about its long-term hold. I've got some Qantas and I'm just wondering, what its effect will be over the next maybe 12 months.
Good, thanks Barry. Look, two good stocks there to talk about. I'll just put my 2 cents worth in before I flick to the panel. But Crown, I think it's a really good time to be looking at Crown. The Chinese government just came out, I think 2 or 3 days ago, said that they wanted to support Macau. They wanted to see Macau successful. Macau's been the problem, been a thorn in their side. For the last couple of years, there's been plummeting revenues from Macau. Part of it was the Chinese government clamping down on money flow, which a lot of hot money was going out via Macau. I think it's a really interesting time to be looking at the stock. It's a stock we held up until about 18 months ago. We sold the stock because we thought it got a bit expensive, and I've been just watching it with interest sense, and I think it's a good time. I wouldn't, at this point, personally, I think Qantas is one to steer clear of after having such a fantastic rally, but that's more of a fundamental perspective. It's a very volatile stock. Now, I might go actually Carl first, technically Crown and Qantas.
Yeah, look, I think contrasting Crown against the previous stock that we were looking at, Monadelphous, saying that in Monadelphous we hadn't seen yet enough capital coming into the stock to say, even if they're just punting that this is the bottom, they might not be absolutely sure about it, but they're dipping a toe in the water. I'm seeing that on Crown, so I'm seeing some good volume coming in on these levels. Now, it could be one or two things. A fund saying, I'm taking a bit of a punt here. It's hit $10, big round number. Or it could be whoever knew why it was going to go down 6 months ago covering back their shorts. Either way, one of those two things needs to happen. Preferably both of those two things need to happen before the stock can rally back up again. So I'm seeing early signs of that happening on Crown. I'd much rather be trying to bottom fish Crown than Monadelphous, for example. Is it a screaming buy that I'd be suggesting as a core holding within my client's portfolio at this stage? Probably not, because it's too early in that cycle. I like to buy on the up. This is more of a turnaround play. So we treat them a little bit more speculative. We allocate a little bit less to them, but I do think it is interesting buying at these levels.
Okay, Qantas, quickly?
Qantas has had a fantastic run, and I think it's starting to slow down. It's losing a little bit of momentum up at these levels. $4, I think, is going to be a bit of a trouble area for it. I think if you've got it, you might want to hedge your bets a little bit and maybe take some profits.
Very oil related, of course.
Sell half, hang on to half sort of thing, or at least start to get some risk management in there with a stop loss on it. At least, that gives you the ability to ride it if it keeps going up.
Yep.
But rest assured that you're protected if it does start to with demand side sideways now, equilibrium starts to turn into supply side. You've got some protection in there, and then you get your money back and go do something else with it.
Yeah. Okay. Now, Ben, Crown and Qantas. I know you've been in Crown before, haven't you? It's
long time ago. It's coming out of the GFC.
Okay. Right.
We got out of it too early in hindsight, and haven't gone back into it. But I think it's looking interesting because everyone's talking negatively about China, but there are some amazing things happening in China. And one of the big things I think for the next decades to come is the Chinese middle market travelling. And, we own, as an example, the two airports, AIA and Sydney. Sydney hit an all-time high this week.
We have both of those in our portfolios too.
And they've both been doing really well. And it's on the view that there's going to be a wave of outbound tourism, which Crown could benefit from with its Melbourne and Sydney casinos and Perth, of course. And also, the Chinese will travel to Macau once this sort of period that they're going through slows down.
It's really been the corruption crackdown that has stopped the flow of people going to Macau.
Right. And the casinos there are having to transition because they were very reliant on high roller business, which has not come back because government officials punting 100 grand on a hand of baccarat is no longer cool in Macau. So they're really having to appeal to the middle market, which is harder work and lower margin.
It'll take a while to build up.
It's going to take a while. But I think it's looking interesting. And Qantas, I think I've told a caller to sell it at 280, so I've got it totally wrong, but I would still say it's a sell. And that's because it's had all of its variables, which are totally outside of its controls, swing into its favour for the last couple of years. And there are signs that the oil price is starting to rise again, that the Australian dollar is falling, and thus offshore travel might start to drop
and
off.
very volatile stock as well.
Very volatile, so I'd sell.
Good. Thank you, gentlemen. That's all. Yeah, again, right. Twice. That's all we have time for today. Thanks so much to our guests, Ben Clark from TMS Capital and Carl Capolingua from Investor Systems, and to you, our viewers, for all your calls and emails. Until next time, I'm Ken Bloomfield from Financial Clarity. Thanks for your company.
The information featured in this program is general in nature and therefore should not be relied upon. Guests appearing on the program may have commercial arrangements with some of the companies mentioned. Before making any investment, insurance or financial planning decisions, you should consult a licensed professional who can advise whether your decision is appropriate for you.